Welcome to Course 14 of the MaxLife Commercial Academy, Multifamily Investing. I'm Ryan Solberg, real estate broker with MaxLife Commercial, license number 3354351. In this course, we're going to cover the entire spectrum of multifamily investment, from duplexes and triplexes all the way up to 200-unit value-add apartment communities. You'll learn how to underwrite deals, access agency debt through Fannie Mae, Freddie Mac, and HUD, execute value-add strategies, and analyze markets like a pro. Whether you're just getting started or looking to scale into larger assets, this course gives you the complete framework. Let's get into it. Multifamily is one of the broadest asset classes in commercial real estate, and understanding the subsegments is the first step to building a sound strategy. At the top of the market, you have Class A properties, new construction, luxury finishes, institutional ownership. These trade at compressed cap rates, often 4 to 5.5%, because the buildings are newer and perceived risk is lower. Class B is the sweet spot for most value-add investors. These are 1980s through early 2000s vintage buildings. Solid bones, but rents are at typically below market. That rent gap is your opportunity. Class C is workforce housing. Yields are higher, but management is more intensive. You're dealing with a resident base that's more economically sensitive and buildings that need more upkeep. Class D is distressed. Significant capital expenditure is usually required before you can stabilize the asset. Then you have the size spectrum. Small multifamily, 2 to 4 units, can still be financed with residential loans, making them highly accessible for new investors. On the other end, institutional assets at 100 units and above open the door to agency debt, syndication, and professional property management structures. Knowing which segment fits your capital, your risk tolerance, and your operational capacity is how you build a durable multifamily portfolio. Underwriting a multifamily deal is fundamentally about two things: what the property earns and what it costs to operate. On the revenue side, you start with gross potential rent, what the property would earn if every unit were occupied at current market rents. From there, you subtract vacancy and credit loss. For a stabilized property in a healthy market, 5 to 7% is typical. Add back any ancillary income, laundry facilities, parking, pet fees, storage units, and you arrive at effective gross income. Now subtract your operating expenses. These include property taxes, insurance, utilities paid by the owner, routine repairs, and maintenance. A capital expenditure reserve, typically $250 to $500 per unit per year, and property management fees, which generally run 8 to 10% of effective gross income. What's left is your net operating income. Divide that by your target cap rate, and you have the value. That's the formula every multifamily investor needs to internalize. Here's where beginners make mistakes. They underestimate expenses or use the seller's pro forma without verifying actuals. Always request 2 to 3 years of operating statements, rent rolls, and utility bills. Build your own model from the ground up. The numbers should tell a story, and you need to be the one reading it critically, not the broker or the seller. Once you move above 4 or 5 units, you enter the world of commercial multifamily financing, and this is where agency debt becomes one of your most powerful tools. Fannie Mae's Delegated Underwriting and Servicing Program, commonly called DUS, is the dominant financing vehicle for 5+ unit properties. It offers fixed and floating rate options, terms ranging from 5 to 30 years, leverage up to 80% of value, and non-recourse structure on most deals. That non-recourse feature alone is a significant risk management advantage. Freddie Mac's small balance loan program fills the gap for deals between $1 and $7.5 million. It's a streamlined alternative with competitive pricing for smaller apartment assets. For maximum leverage on stabilized properties, HUD's 203F program is in a class of its own, up to 85% LTV, 35-year fully amortizing terms, fixed rate, and non-recourse. The trade-off is time. Expect 6 to 9 months to close. Now, what about value-add deals that aren't yet stabilized? Agency lenders won't touch those. That's where bridge lending comes in. Bridge loans are short-term, typically 1 to 3 years, at higher rates, usually SOFR plus 3 to 500 basis points. You use bridge capital to acquire and renovate, stabilize the asset, and then refinance into permanent agency debt. Understanding this two-step financing strategy is essential for any serious value-add investor. The value-add multifamily playbook is about systematically converting a below-market asset into a stabilized institutional quality property that commands higher rents and trades at a lower cap rate, which translates directly to appreciation. Let's walk through the core levers. Interior unit renovations are the most direct rent driver. New LVP flooring, granite or quartz countertops, stainless appliances, and updated fixtures typically justify rent increases of $100 to $250 per month per unit in most Central Florida markets. In-unit laundry is one of the highest ROI upgrades available. Residents will pay a consistent premium for it, and the install cost is recoverable within 18 to 24 months in most cases. Smart home technology, keyless entry, smart thermostats, high-speed fiber internet is becoming table stakes for Class B renters and can support additional monthly fees. On the expense side, implementing a ratio utility billing system, RUBS, shifts a portion of water and electric costs back to residents, which directly improves NOI without touching rents. And replacing underperforming property management is often the single highest impact operational change you can make. On the flip side, watch out for deferred maintenance and code violations. These are not value add opportunities, they're liabilities. And never underestimate renovation costs. Build in a 15 to 20% contingency from day one. Even the most well-executed value-add business plan fails if you're operating in the wrong submarket. Market analysis is not optional. It's the foundation that validates or invalidates every assumption in your underwriting. Start at the macro level. Is the metro area growing in population and jobs? Central Florida is one of the strongest multifamily markets in the country, driven by tourism, employment, defense, and aerospace along the Space Coast, and an enormous in-migration from higher-cost states. But even within a strong metro, submarkets vary dramatically. You need to understand vacancy rates at the submarket level, not just the metro. Below 5% vacancy is healthy. Below 3% is a landlord's market. Look at 3-year trailing rent growth, not just current rents. A submarket with consistent 3 to 5% annual rent growth has real momentum. Understand the supply pipeline. Are there 2,000 new units being delivered within a mile of your acquisition? That could cap your rent growth for 2 to 3 years. And look at the employment base. A submarket anchored by one employer or one industry is fragile. At MaxLife Commercial, we track these metrics across all of our core Central Florida submarkets. If you want to talk through a specific market or deal, give us a call at 321-586-2121. One of the most powerful aspects of multifamily investing is the range of entry points and acquisition strategies available to investors at every capital level. The house hack is the most accessible starting point in real estate. You buy a duplex, triplex, or fourplex using an FHA loan with as little as 3.5% down, live in one unit, and let your tenants cover the mortgage. It's how many of today's largest multifamily investors got their start. The BR method: buy, renovate, rent, refinance, repeat, is the engine of small multifamily portfolio building. You acquire a distressed property below market, force appreciation through renovation, refinance at the improved value, and pull your capital back out to fund the next deal. Done correctly, you can build a substantial portfolio with the same initial equity stack. As you move into the 5 to 20 unit range, you shift into commercial financing territory. Local banks, credit unions, and regional lenders become your primary capital sources. Seller financing is an underutilized strategy, particularly with mom and pop operators who have owned a property for decades, don't need a lump sum, and want income without the management headache. And for investors with equity in appreciated assets, the 1031 exchange is one of the most powerful tax deferral tools available in the tax code. At any scale, the right structure depends on your capital, your goals, and your timeline. Our team at MaxLife Commercial helps investors identify and structure these deals across Central Florida. As we close out this course, let's distill multifamily investing down to 4 principles that I've seen separate successful long-term investors from those who struggle. First, buy the basis, not the pro forma. Every seller presents an optimistic projection. Your job is to stress test every assumption: vacancy, expense ratios, rent growth, exit cap rate. If the deal only works at the seller's numbers, it doesn't work. Second, know your exit before you enter. Before you close, you should have a clear thesis. Are you holding for cash flow, executing a 5-year value add and sale, or building toward a 1031 exchange? Your financing structure, renovation scope, and management strategy should all align with that exit. Third, property management is the business. I cannot overstate this. A well-managed Class C property outperforms a poorly managed Class B property every time. Interview multiple management companies, check references, and understand their fee structure and reporting systems before you hire. Fourth, reserves save deals. The investors who lose assets almost always have one thing in common: they were undercapitalized. Major capital expenditures, roofs, HVAC systems, plumbing, will happen. Have the reserves to handle them without a crisis. These 4 principles apply whether you're managing a 4-unit building in Kissimmee or a 200-unit community in Orlando. Build your foundation on discipline, and the returns will follow. That wraps up Course 14, Multifamily Investing. You now have the full framework: how to evaluate the multifamily landscape, underwrite a deal from gross revenue to NOI, access agency debt at scale, execute a value add playbook, analyze markets and submarkets, and structure deals at every size from a duplex to a 200-unit community. The next course in the MaxLife Commercial Academy is self-storage investing, a completely different asset class with its own unique dynamics and opportunities. I'm Ryan Solberg, real estate broker with MaxLife Commercial, license number 3354351. If you have questions about a specific deal, a market, or how to get started in multifamily investing, give us a call at 321 586-2121 or visit us at maxlifedevelopment.com/academy. We work with investors across Central Florida every day, and we'd love to help you find your next deal. Thanks for watching, and I'll see you in the next course.